Hello, very good morning to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Very good morning. Today will be Tuesday, the 18th of March, 2025. So as usual, before we start the gist of today's Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future. This presentation, okay, give me a minute, yeah. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into today's technical analysis on the intraday basis, let's have a quick recap of what has taken shape yesterday in terms of news flow, economic data releases, those relevant ones, and as well as their impact on the broad-based cross-asset classes. So let's start with the relevant news flow first, all right, in terms of the news flow. So yesterday's, what you could see over here is that yesterday's, there's one particular relevant news flow is rather important. This is more from a longer term perspective. OECD, we know that OECD is actually a kind of a independent, we call it organization within the G20, the G20 countries. That means talk about those developed nations. It's an organization, and they actually yesterday kind of give their latest forecast on global economic growth, and as well as the individual G20 countries projection of 2025-2026 economic growth, that means GDP growth, and as well as inflation forecast. So OECD warns that Trump's erratic or hawkish tariff policy are likely to drag on growth over here as Trump continues to press on with trade tariffs. What he's going to press on over here is this reciprocal trade tariffs against the rest of the world. So Trump said that these next tariffs will go ahead on the 2nd of April. And the worst hit will be US as well, because it's going to be boomerang back. Mexican and Canada growth will all suffer under this hawkish and erratic tariffs plan over here. And also over here is that they actually downgraded the global growth to slow slightly from 3.2% in 2024 to 3.1% in 2025 and 3% in 2026 over here. So what is basically in a nutshell is actually number one, stagflation risk. All right, stagflation, that means potentially US global trade tariffs policy at this juncture, that means based on the way that they're going to implement it, is likely to go and drag down global growth. And on the other hand, inflation may remain sticky. So like I mentioned in my daily dose yesterday is that central banks' current accommodative monetary policy will be in the defensive mode. That means, i.e., if there's going to be a negative shock to the risk asset, particularly the US stock market, which has been on a weaker footing in the last 4 weeks or so, despite yesterday rebound that was seen in the benchmark US stock indices yesterday. Fundamentally, there is this structure that is being what I call more negative than positive at this juncture. That means given stagflation risk is rising, if there is going to be a negative, much more prolonged weakness in the US stock market, it will start to drag down into consumer confidence, which has been seen in the University of Michigan consumer confidence data for March, the preliminary figure, which I highlighted yesterday as well. That will lead to what I call a lesser wealth effect on the real spending of the US consumer. And this real spending of the US consumer is retail sales, which has started to slow down as well as being reported yesterday. Later I'll show on the retail sales figure. So once the real economy got hit by this, because slowdown in economic growth, usually the US central bank will come in to pump in more liquidity to the market and the stock market will rise. Okay, but this time around, their hands are tied. They'll be more on defensive mode because of stagflation fears. If they start to pump in more liquidity, potentially inflation pressure will start to rise as well because it's a supply shock given this trade tariffs policy that's being implemented by the current White House administration. Right. So this what I mean about here is that the real economy now is actually showing signs of weakness. And yesterday's due to this trade tariffs policy causing uncertainty and lead to weaker consumer confidence, this has started to play out in consumer spending. So yesterday, US retail sales over here, if you look at the retail sales of the US for the month of February over here, yeah, retail sales. Okay, so you look at retail sales year on year, February, it actually dropped to 3.1% to 3.9% year on year in January. That's for February figure. If you look at the trend, okay, give me a couple of seconds to run. This is hang right now. I'm not sure what's going on. Okay, year on year. Okay, so two consecutive months of slowdown in retail sales year on year, and this breakdown of 3.1% year on year is the slowest since October 2024. All right, so that's about a 4 month low. All right, so we start to see if you look at the 5-year trend, okay, very clearly it starts to be flattish in terms of retail sales spending in the US. So what I could see over here is that there is clearer signs that number one, US economic growth is now starts to turn more soft. And turning soft doesn't mean that inflation will start to fall, but in fact, inflation may remain sticky due to Trump's trade tariffs policy. And with that, central bankers in US, central bank in US, the Fed, their hands are tied, and they may not be able to introduce more monetary policy stimulus to jumpstart the economy if the we call it the stock market continues to face further weakness going forward. All right, then with this stagflation risk that is taking shape right now, gold price actually rallied to fresh all-time high yesterday. So if you look at gold price over here, which I will share later, I'll share gold price XAU/USD cleared above the 3,000 psychological level, now printing at 3,011 as we are speaking right now. So what are the key levels to watch out for today and the trend bias? Later I'll share with you all in my intraday technical outlook. And for those who recall yesterday's intraday technical outlook on gold XAU/USD, we remains on a bullish bias. All right, that came in with our expectation. And now let us shift the focus on the performance of the major US stock indices. Yes, the major US stock indices all closed in the green yesterday, with the SPX up 0.64%, the Nasdaq up 0.55%, the Dow Jones up 0.85%, and the Russell 2000 up 1.19%. But during the last hour, there was actually a minor sell-off on the major stock indices. And what's interesting over here is that on the Nasdaq 100, which I highlighted yesterday, we do have bearish bias below the short-term pivotal resistance level at around the 19,790, 19,900 level, and that bearish reaction hit exactly at the short-term pivotal resistance on the Nasdaq 100, which I highlighted in my intraday technical outlook yesterday, and slide down within our expectation. So there's some form of technical weakness on the intraday basis yesterday when the Nasdaq 100 or all the major stock indices hit this parallel short-term pivotal resistance level, and also on the Dow Jones Industrial Average as well, which is the represented by the US Wall Street 30 in our platform at around the 41,900 mark, 42,000 psychological level, where the bearish reaction took shape during the last hour of the US stock market cash trading session yesterday. So very interesting move on the market. So despite the fact that yes, the US market shaped a 2-day rally, but this 2-day rally is not convincing in my point of view that it may start to kickstart a medium-term uptrend, and there's still a risk that this ongoing 4-week of decline in the major US stock indices may continue to extend to the downside. So later I'll share with you what are the key levels to watch out for today. And given the heat, now let's take through the heat map of the S&P 500. So you look at the heat map of the S&P 500, yes, there are more greens, but however, the the major generals are not actually rather bullish, right? So the major generals, we're talking about the mega cap technology stocks, there are more reds than green that is being shown, especially Nvidia yesterday underperformed, down by negative 1.76%, followed by Tesla, which is down by negative 5%, and we start to see lackluster performance in Amazon as well, down negative 1.12%, followed by Google down negative 0.6%, and Meta, Facebook down negative 0.4%, Apple almost unchanged, positive 0.24%, and Microsoft positive 0.04%. So net overall, we start to see, yes, 2 days of rally in the major US stock indices, but however, this rally, yesterday rally, is not being, we call it pick up by the major generals, which is the leader of the leader of the major US stock indices, which is the mega cap technology stocks, mega cap stocks that actually underperformed the benchmark US stock indices yesterday. So this is not a rather healthy kind of rally, given that it's only the troops that are rallying and the mid-tier general that's rallying, but the major generals, which is the mega cap stocks of the major US stock indices, are not following yesterday's positive movement on the major US stock index. That means, i.e., a sign of what I call weakness rather than strength. Okay, now with the move with this particular set of news flow, let us look at the performance of the FX market. So the performance of FX market is rather mixed right now at this juncture. We start to see dollar strength coming back into the dollar yen. So dollar yen yesterday, I highlight in my daily dose of market insights, on the intraday basis, we do expect this corrective rebound, but their overall medium-term trend is still down, remains down on the dollar yen, supported by fundamentals and intermarket dynamics. We'll share with you all later. And bear in mind, tomorrow Bank of Japan will meet, and Bank of Japan is likely to be stamped. That means they are not likely to actually increase interest rate this time around for March, given the fact that they have been increased in the previous month this year. And also they may start to give a much more guide of we call it confidence guidance that the Japanese wage growth in Japan has starts to increase on the upside, and going forward they may start to guide the market in their potential next interest rate hike that will come in the summer months of this year, which is either June or July. So that actually explain to us potentially going forward the dollar yen still potentially could still continues to trade within a downtrend phase after this corrective rebound phase after this potential corrective rebound phase end. Right, so what I could see over here, the rest of the other dollar pair starts to trade sideways yesterday. Okay, so stuck in the range. The dollar against the euro, the dollar against Swiss franc, and the dollar against the sterling pound. And interestingly, yesterday's underperformer was the Aussie dollar against the US dollar. That means what you could see of yesterday's dollar underperformed against the Aussie. That means the Aussie strength and the Kiwi strength against the USD. So this is actually being quoted as 1 USD equals to how many Aussie dollar. But what I could see as we are speaking during the Asia session, the dollar is now appears to playing catch up against the Aussie dollar, and that also starts to drag up the dollar Kiwi rate as well. So very interestingly, later I'll share with you all, in fact, the Aussie dollar now is at a resistance at 0.64 level, which is a very key resistance level. So that will explain to us why there is some form of hesitance by the Aussie bulls to push it further at this juncture. So we start to see a bit of dollar strength coming back into the Aussie dollar as we are speaking right now. Okay, there's this slight tick up over here. So later I'll touch on the short-term intraday technical outlook on the Aussie dollar. What are the key levels to look out for? All right, and one particular news flow highlight is the Japanese stock market rallied today, up by actually so one of the top performer among the Asia indices, up by 1.46%. So the top performer is for sure still remains on the Hang Seng indices, which is up by 1.81%. The Hang Seng Tech is up by 2.45% due to a more positive rosy sentiment towards China AI stocks, related stocks that are deemed to be much more cheaper in terms of operational standpoint, given the fact that OECD has warned of slower global economic growth. So companies that want to actually implement AI-driven models to boost their bottom line may tend to seek out for China-related AI models rather than US-based AI models. So that actually explain a flow of funds heading towards this China-related AI stocks that is actually keeping up or reinforcing this ongoing medium-term uptrend phase that is seen on the Hang Seng benchmark stock indices in the last 4 weeks or so. So today's rosy run on the Nikkei 225 that is up by 1.46% as we are speaking is due to this positive news flow from the legendary Warren Buffett. So Warren Buffett investment house has increased its stake on Japanese those traditional trading houses, which is Mitsubishi Co, Marubeni Co, Mitsui and Company, and Itochu Co and Sumitomo Co Corporation. So that actually created a positive feedback loop into the Nikkei 225 as well. So this is one of the positive news for catalyst that is igniting this intraday rally in the Nikkei 225 over here. So later I'll touch on what are the key levels to watch on the Japan 225, which is representing the Nikkei 225 in our platform over here. Yes, so this is the news flow that I want to cover in the first part of today's daily dose. So now let us move on to the second part of today's daily dose, which is the fundamentals and intermarket dynamics that is taking shape right now that could lead to a much more multi-week time horizon on the impacted instrument. So let us start with gold at this juncture. So gold, most of us has been much concerned that gold has rallied by a fair bit in the last 2 weeks. Can this rally continue, or is this just a bubble in gold where gold price could collapse from here? So let me share with you the fundamental and intermarket backing that is supporting this ongoing medium-term uptrend and major uptrend in gold price. So we know that gold itself doesn't have any interest income. That means, i.e., if you hold gold from a longer term perspective, you don't get any interest income like holding on to a traditional government bond or a corporate bond, because it's a zero interest bearing asset. So given that it's a zero interest bearing asset, if global real interest rate, that means stripping out of inflation expectation, is on the high side, that means real interest rate keep going up, gold prices will tends to face gold bullish movement will tends to slow down, because i.e., if you hold gold in the longer term perspective, there will be a higher opportunity cost given real interest rate is rising. But right now, using the benchmark US 10-year Treasury real yield, that means I strip off of inflation expectation, not nominal yield, that means a real yield, that means 10-year is a benchmark, given the fact that the 10-year US Treasury yield is being used to price longer term fixed income instrument. All right, so given that this risk-free benchmark rate, real yield, that means stripping off of inflation expectation, continues to actually be on the weaker side of the story right now from a intermarket perspective. What I could see over here is that the US 10-year real yield has since hitting the high of 2.37% in 15th of January, it starts to trade down, and recently it just broke below the 50-day moving average as well, with a 2.10% medium-term pivotal resistance over here, which is close to the 50-day moving average as well. So as long as this 2.10 medium-term pivotal resistance is not surpassed to the upside, gold price may continues to accelerate. All right, so what you could see over here is that there's this ongoing multi-month decline in the US 10-year Treasury yield since the high of 15th of Jan, and that led to a multi-month rally in gold price over here. And what's interesting over here, recently, or was it last week, gold price broke above the upper boundary of this major ascending channel that I drew from the low of October 2023, and due to this bullish breakout of this upper boundary of this major ascending channel, it represents potential bullish acceleration in gold price XAU/USD. What we could be depicted by this multi 3 month, okay, this 3 month of steeper uptrending ascending channel from the low of December 2024. So that's about 3 months or 2.5 months past, give or take. All right, so what I could see over here is that this push up last week has starts to actually accelerate on the upside for gold XAU/USD. So a lot of people are saying that this potential acceleration over here, is this a fake bullish breakout of the upper boundary of the longer term ascending channel, where it could potentially mean revert back into the middle part of the ascending channel again? That means back to around the 2,750 level. Fundamentally is not supporting that reintegration back into this 2,754 level, because stagflation risk is rising. OECD has already reduced their global growth forecast for world economic growth yesterday, and also warned the sticky inflation situation due to Trump's erratic hawkish trade tariffs policy against the rest of the world, and also based on a fundamental intermarket dynamics that longer term US 10-year Treasury yield is actually now inching on the downside, with 2.10% as the medium-term pivotal resistance, supporting further softness in the US 10-year Treasury yield, real yield, US 10-year Treasury real yield, I repeat again, that also potentially reinforce this ongoing bullish acceleration in gold price. So the odds are seems to be supporting this medium-term uptrend and major uptrend in gold XAU/USD, rather than a bubble that is forming in gold right now. All right, so that's for the intermarket and for dynamics for gold XAU/USD. Now let me touch on another intermarket dynamics for the dollar yen. So we know that the dollar yen yesterday rallied, so that came in with our expectation as well for a very short-term intraday technical perspective. So we know that price action for liquid tradable instrument don't go vertical up and vertical down, they actually oscillate with the trend. So the trend of the dollar yen still remains on the medium-term downtrend, supported by this intermarket dynamics that I will share with you guys over here. So this intermarket dynamic I share with you guys is the spread between the 10-year US Treasury yield and the spread between the 10-year JGB yield. So take into account is the differential between the 10-year interest rate in US and the 10-year interest rate in Japan, represented by their respective government bonds yield. And also the shorter term one, the 2-year Treasury yield minus the 2-year JGB yield. All right, so look at this dotted line here. Okay, this dotted line here at the bottom is the dollar yen rate. Okay, so notice that previously the yield spread between the 10-year Treasury US Treasury yield and the 10-year JGB yield hit the resistance level at around the 3.7 level, 3.7 level over here. Let me put it, I think, okay, 3.60. Okay, so this is error. 3 point. Let me. Oops. Okay, let me change this. So this should be 3.60. It's a typo error. So 3.60%. The level here 3. Okay, give me a minute. Okay, let it run for a couple of seconds so that I could make the correct adjustment. 3.60 here. Okay, 3.6% over here. So this 3.6%, once it hit this 3.6% resistance on the yield spread, the yield spread continues to decline for the 10-year yield spread between the US Treasury and the JGB. And in parallel, the 3.84% resistance, which is the 2-year US Treasury yield spread between the 2-year US Treasury yield and the 2-year JGB yield, then thereafter it continues its downtrend. Right, you could see both the 10-year spread and the 2-year spread. So once this 10-year and 2-year spread continues the downtrend after hitting the parallel key resistance level, that actually causes the dollar yen to actually decline, significant decline as well. All right, over here. So think this as a way of looking is that the attractiveness to actually hold US fixed income is lesser versus the Japanese fixed income. That means that will also see lesser demand of US Treasury over JGB, which is the Japanese government bonds. So that also pressure the, in a way, I would say indirectly pressure the dollar yen rate to actually create a medium term decline, since the start of the year, which is 10th of January, all the way down to the low of 2 weeks ago, last week, 11th of March precisely. Then after that, in the last 3-4 days, it staged a corrective bounce. All right. So, given the fact that the 10-year Treasury yield spread and the 10-year yield spread between the US Treasury and the GGB and the 2-year yield spread between the US Treasury and the GGB continues to see further potential decline because they are still evolving within their medium-term downtrend dynamics, that could actually create another negative feedback loop back into the dollar yen for allow it to potentially resume its medium-term downtrend phase, given the fact that we know that BOJ market is not expecting it to actually raise interest rate tomorrow, but they may start to give a much more solidified guidance that Japanese wages continues to rise on the upside, and that also support their gradual interest rate normalization policy and set the stage for the markets to actually guide it that the next interest rate hike may come into the summer months of 2024, either in June to July this year. Okay, so this is the two intermarket dynamics I share with you guys. Firstly, on gold XAU/USD and on the dollar yen. So with that, now let us quickly jump straight into the technical outlook, the intraday technical outlook on the broad-based cross asset classes. Starting from the FX market. But before that, let me expand my screen so that you guys could see a better view on the charts over here. All right, so let us start with the FX market first. Euro dollar. So euro dollar, no change, continues to hover in the neutrality zone that we highlighted yesterday. So still remains on the neutrality stance between 1.0940/1.0970. Lower limit of the neutrality zone will be at 1.0810 over here. So, and also momentum is not that great right now as the hourly RSI hit the overbought level during the start of the US session yesterday, and as we are speaking right now during today's Asia session, it has broken down below a parallel ascending trendline support, indicating the lack of upside momentum. So given the lack of upside momentum as being depicted by the current observation or reading of the hourly RSI, which is not so bullish or not so rosy, we will still maintain our neutrality stance on the euro dollar. So neutral between 1.0940/1.0970, lower limit 1.0810 for now. Right. Onward next will be the sterling dollar. So the sterling dollar yesterday broke above last Friday or last Thursday high, which is so our 1.2980, 1.2980 short-term pivotal resistance that we highlighted earlier. So with that, potentially what we could see right now that there's some form of momentum that is coming into the picture for the sterling dollar. So given that yesterday it hit the overbought level, and this minor pullback is just a kind of what I call a workout or a removal of this overbought condition that was seen yesterday. And given yesterday overbought level, there is no form of bearish divergence at this juncture. And right now, the support level on the RSI, okay, oops. Okay, comes in at around the 38 level mark over here, the previous higher low that has been supporting it. All right, so given the fact that yesterday's push up above this prior short-term pivotal resistance yesterday, and the hourly RSI is not shipping any bearish divergence, there could be some form of risk that the sterling dollar may continue this short-term intraday upward movement on the sterling dollar. So on the sterling dollar. So with that, we will flip to a intraday bullish bias using two key support level to watch will be this breakout level yesterday. Okay, this kind of a trend line breakout. Yeah, this breakout here. Okay, let me remove this. Okay, you can see 1.2950 as my first support level. 1.2910 will be my intraday short-term pivotal support, which is the intraday low on last Friday, 1.2910 over here. So that also been supported on last Wednesday as well. So using 1.2910 in any form of any pullback that's been surpassed below 1.2910 short-term pivotal support level on the dollar, on the sterling dollar, pardon me, we will flip to a intraday bullish bias. First resistance level to watch for today, 1.3025/1.3040. Only an hourly close below 1.2910 will invalidate today's intraday bullish bias to kickstart that minor corrective decline phase again on the sterling dollar, exposing the next near-term support level at 1.2865, followed by 1.2810, which is also being supported by the 200-day moving average as well. Okay, so that's for the sterling dollar. Onward next will be the Aussie dollar. So the Aussie dollar yesterday did a squeeze up, but this squeeze up managed to stall again at the 64 pivotal resistance level. So this 64 pivotal resistance level is a very key medium-term pivotal resistance. Why? Because on the daily chart, this is actually a major former ascending trend line drawn from the low of October 2022 and now turns into a major pullback resistance that got rejected by the previous bulls on 20th of February, and right now there is some form of stalling again as we are speaking right now, right below the 64 level. So this is considered as a medium-term pivotal resistance level over here. So with that, we will still maintain the intraday bearish bias. Pardon me, we'll still have an intraday bearish bias on the Aussie dollar for now at 64 figure level, but a tighter first support level to watch for today will be 63.50. Was yesterday's bullish breakout level. Only a breakdown below 63.50 may see further weakness on the intraday basis for today to revisit 63.20. All right, so two key near-term support level to watch. In first step, 63.50, followed by 63.20. But however, if we start to see a hourly push up and hourly close above 64 figure level, then today's intraday bearish bias will be invalidated to see a further squeeze up to potentially expose the next near-term resistance level at 64.30, followed by 64.70 next, which is the graphical minor swing high of 12th of December last year and 9th of December last year. So that's for the Aussie dollar using 64 figure medium-term pivotal resistance to have a intraday bearish bias for today. But first support you got to break fast will be 63.50. Now, onward next will be the dollar yen. So let's explain to you the dollar yen yesterday shape that rebound as expected. It's coming very close to the resistance that we highlighted as well for this minor corrective mean reversion rebound scenario that is playing out right now at 150 figure, 150.50 over here. So with that, since it's coming very close to this resistance level over here, we will try to actually fade the rally. That means flipping to an intraday bearish bias for today upon hitting close to this level. But since you haven't hit this level yet, there's no form of bearish candlestick that's being formed. We use a slightly higher pivotal resistance for today at 151.30, which is the minor swing high area of 3rd of March. And graphically, it's also the former minor low of 7th of February and 18th of February turns into a pullback resistance that was rejected on 3rd of March over here. Could see very clearly. All right, so using 151.30, a slightly higher level than the resistance zone for that ongoing minor corrective mean reversion rebound phase that is playing out, which is a bit of move more to go. 151.30 in a short-term pivotal resistance level. Potentially, the dollar yen may revert back to its impulsive downward sequence, supported by the intermarket dynamics that I shared with you earlier between the dollar yen and the yield spread of the US Treasury and the JGB yield. First support level to watch out for will be at okay, for today. In fact, there's these two support level to watch out for today on the intraday basis. Okay, it will be at 149.10. Okay, followed by 148.20, which was yesterday's low. And this 148.20 is also the current minor ascending trend line that is supporting this ongoing minor corrective rebound phase since the low of last Tuesday. All right, only a clear breakdown below 148.20 will increase the odds of the revival of the impulsive down move of its medium-term downtrend phase to potentially expose the next support level at 146.50/25. Right. However, if price action starts to pierce up and have an hourly close above 151.30 short-term pivotal resistance level, the bearish bias will be invalidated for the dollar yen to see a squeeze up for today to actually re-expose the next near-term resistance level, which is close to the 50-day moving average. Okay, at 152.40 next. Okay, let me put it writing. 152.40. All right, so actually it also corresponds closely with the 200-day moving average as well. So it's in between the 200-day moving average and the 50-day moving average. All right, 152.40. So in a nutshell, since it's coming very close to the mean reversion resistance zone that we highlighted yesterday, 150 figure slash 50, potentially there could be some form of continuation of the impulsive downward sequence on the dollar yen, given the fact that the intermarket dynamics is supporting the ongoing medium-term downtrend of the dollar yen. We will flip to an intraday bearish bias on the dollar yen for today using 151.30 short-term pivotal resistance for today's potential intraday bearish bias on the dollar yen. First support level that you got to break will be 149.10, and below 149.10 may expose 148.20 on the intraday basis. Unless we start to see a very drastic fall below 148.20, then the odds will start to increase for the impulsive down move sequence to actually kickstart on the dollar yen thereafter. All right, so that's for the intraday technical outlook on the dollar yen, where we have a bearish bias below 151.30 short-term pivotal resistance. All right, now let us move on to the major stock indices, starting with the Hong Kong 33. So the Hong Kong 33 representing the Hang Seng Index going to rise as expected over here and clear above last 24,500 level, the first resistance that we highlighted, and right now it's actually shaping a bounce of it as well, we could see. So given the clearance and the rebound right off the first resistance now turns into a first support level at 24,500 level, we could actually tighten our short-term pivotal support level for today at 23,290. So using a tighten short-term pivotal support level for today at 23,290, I repeat, tighten short-term pivotal support at 23,290, we will maintain a intraday bullish bias on the Hong Kong 33. Next resistance level to watch 25,080. Above it potentially sees 25,750, which is the 0.618 Fibo extension, and as well as the upper limit of this ongoing medium-term uptrend channel that is still in place since 10th of January this year. However, only an hourly close and a breakdown below 23,290 will negate today's bullish bias to see an extension of a minor corrective decline to revisit 22,470, which is so confluence with the rising 20-day moving average and as well as the lower limit of the medium-term ascending channel. So that's for the Hong Kong 33. Onwards, next will be the Japan 225. So the Japan 225 managed to clear above the 20-day moving average, which is also our short-term pivotal resistance for yesterday, invalidating that minor bearish bias that we have on yesterday. And for now, we will flip to an intraday bullish bias given of the intraday bullishness that is being seen on the Japan 225. So using 37,610 as my short-term pivotal support level, which correspond closely with the 20-day moving average as well, now acting as an intermediate support area level on the Nikkei 225 or the Japan 225. Flip to a intraday bullish bias. Near-term resistance level to watch out for will be 38,325/490, which correspond very closely to the 200-day moving average and the 50-day moving average coming close to act as a similar resistance zone as well. However, a breakdown below an hourly close below 37,610, that will invalidate our intraday bullish bias to kickstart another round of corrective decline sequence on the intraday basis, exposing the next near-term support level in first step 37,200, followed by 36,830 next. So that's for the Japan 225. Next up will be the German 30. So the German 30 continues rally as expected and hit our first resistance level at 23,220. So given that there's no clear hourly close above 23,220, we do not want to tighten our short-term pivotal support to be so tight at 22,910. So 22 22,910 will be my first support level to watch. That's yesterday's European session low, but still maintaining that short-term pivotal support at 22,740 that correspond to the 20-day moving average as well. Still maintaining that intraday bullish bias on the German 30. After 23,220, the next resistance level to watch will be close to the current all-time high area at 23,600. Above it, potentially sees 23,820. That's being defined by a Fibo extension cluster level. However, a breakdown with an hourly close below 22,740 will negate this intraday bullish bias to see it sliding further to revisit 22,440, which is the lower limit of this medium-term ascending channel that I drew from the low of 13th of January. Right, only a breakdown below 22,410 will kickstart a kind of a multi-day corrective decline sequence, exposing the next near-term support level in first step at 22,120, which is coming very close to this rising 50-day moving average as well. So in a nutshell, still given that it hasn't have a clear breakout above 23,220, that's our first resistance yesterday, we'll still maintain our intraday bullish bias using the same pivotal support as yesterday, which is 22,740 for the German 30. All right, over here. Now, next up will be the major US stock indices. So the major US stock indices over here, it rallied, and the rejection got rejected exactly at our short-term pivotal zone that we highlighted, the upper limit, which is 41,980. All right, we also correspond closely to the 200-day moving average as well. So using 41,980, because this is the upper limit. Okay, 41,980 short-term pivotal resistance level on the US Wall Street 30, representing the Dow Jones Industrial Average. We do have a bearish bias for today. First support level that you got to break down will be 41,450, which is the former minor swing high of 14th of March, and also the minor ascending trend line that I drew right now from the low of 14th of March. So a breakdown below 41,450 will increase the odds of this intraday bearish biasness to revisit last Friday minus swing low area at 40,665. However, if price action have an hourly close above 41,980, then this ongoing minor corrective rebound phase will extend and invalidate today's intraday bearish bias to see the next near-term resistance coming in at 42,490. Above it, potentially sees 42,980/43,120, which correspond very closely to the downward sloping 20-day moving average as well. Okay, so that's for the US Wall Street 30 using 41,980 short-term pivotal resistance level, given the negative reaction of it right now, and have a intraday bearish bias for today, with the first support level to watch will be at 41,450. Right, so that's for the US Wall Street 30. Onward next will be the Nasdaq 100. So the Nasdaq 100 also got rejected at the upper boundary of our short-term pivotal resistance yesterday, which is at this 9,910 level. All right, so let me adjust it slightly better. 910 level. Okay, so still using this. That also, if you look at the hourly RSI from here, okay, there's a bearish breakdown of the parallel support. All right, indicating the lack of upside momentum right now as we are speaking, right, with the breakdown of this parallel ascending trendline support on the hourly RSI. So with that, still having that bearish bias for today on the US Nasdaq 100, using for sure 19,910 as my short-term pivotal resistance level to have that intraday bearish bias on the Nasdaq 100. But we do have a first support level to watch out for. Okay, for today will be at 19,540. All right, let me put it in writing. 19,540. Okay, so only a breakdown below 19,540 will increase the odds of today's intraday bearish bias to revisit last Friday and last Tuesday minor swing low area at 19,125. However, an erupt push up and hourly close above and a breakout above 19,910 short-term pivotal resistance that will invalidate today's intraday bearish bias to see the extension of this minor corrective rebound sequence, to extend it to expose the next near-term resistance level at 20,340, which correspond to the 200-day moving average. Above it potentially sees 20,720 next, which is pretty much 20,720 next, pardon me. All right, so i.e. in a nutshell, still using 19,910 as my short-term pivotal resistance on the Nasdaq 100 to have an intraday bearish bias for today, with the first near-term support level to watch will be at 19,540. All right, so that's for the Nasdaq 100, and also sum up the intraday technical outlook on the major stock indices. So let us now focus our attention to the commodities market, starting with the Gold XAU/USD. So for Gold XAU/USD, price action continues to rally and surpass the 3,000 level and almost hit 3,016 level, which I highlighted earlier on yesterday's intraday technical outlook. So no signs of bearishness on the hourly RSI. The RSI continues to remain supported by this ascending trend line over here. So now we have a steeper ascending trend line. Okay. Given the fact that it hasn't hit the, it hasn't shown any bearish divergence yet, as it continues to flirt the overbought zone over here, indicating a positive momentum. Yes, there could be a bit of pullback taking shape during the European session, given that it coming to the overbought level right now above 70 on the hourly RSI. So first pullback support level to watch will be 3,000 level. So as long as this minor pullback didn't surpass below our Titan short-term pivotal support level for today, which is at the 2,978, the former minor range support of last Friday, 2,978. So as long as this minor pullback didn't surpass below a Titan short-term pivotal support that I have for today, 2,978, we'll still maintain that intraday bullish bias for Gold XAU/USD. Next support level to watch after 3,016 will be 3,030, 3,040, and above 3,040 may see 3,058 to come in next, okay, which is defined by the 0.618 Fibo extension that I drew from the low of 11 of March, and also potentially the ongoing upper limit of this ongoing minor ascending channel that I drew from the low of 11 of March as well. All right, only hourly close and a push down below 2,978 today will invalidate today's intraday bullish bias on Gold XAU/USD to kickstart a minor corrective decline or a mean reversion decline to revisit 2,954 and potentially even retest the 20-day moving average at 2,923 next. So i.e. in a nutshell, using a Titan short-term pivotal support at 2,978 for Gold to maintain the today's intraday bullish bias. Right, lastly will be the West Texas crude oil over here. So the West Texas crude oil, let's take a look at the daily time frame chart over here. So the daily time frame chart over here managed to actually continue to hold at the 6440 pivotal resistance level, pivotal support level. That's the key range support level. That is key major range support level that is in place since 20th of March 2023. So that's about 2 years ago, but can't break above the downward sloping 20-day moving average. But momentum, MACD trend indicator has started to turn positive. Why? Because if you look at the MACD histogram, price action shape lower low over here, but the histogram shape higher low. And yesterday it starts to show a bullish crossover as well, so indicating that this medium term or this 3 month of downtrend, since the start of 15th of January 2025 all the way down to last week low, upon hitting the major range support at 6540, the downside momentum has started to ease off. That means right now the West Texas crude oil could potentially see a bit of corrective rebound phase taking shape from a multi-day perspective to potentially revisit around the 50-day moving average after breaking above the 20-day moving average going forward over here. All right, so in shorter term time frame, on the hourly time frame, we are not so confident to have a bearish bias where we have yesterday at 68.80 over here. So potentially there could be some form of corrective rebound taking shape. That means, i.e., the West Texas crude oil may potentially grind higher, given the daily positive observation that is being shown on the daily MACD trend indicator, which I highlighted much earlier, a few seconds ago. So with that, I will use 6645 short-term pivotal support level on West Texas crude oil. For today, we will flip to an intraday bullish bias for West Texas crude oil for this potential corrective rebound phase to play out. first resistance level to watch will be 68.80. A breakout above 68.80 potentially may see the next near-term resistance to come in at 69.50 in first step. Only a hourly close below 66.45 will invalidate or negate today's intraday bullish bias to revisit the major range support area again at 65.70/40 next. All right, so that's for West Texas crude oil, flipping to an intraday bullish bias because of the positive technical elements that is being seen on a higher time frame daily chart, using 66.45 as my short 66.45 as my short-term pivotal support level for today. All right, so that also sum up all the intraday technical outlook on the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? So for today, Tuesday, will be in European session. There will be the Eurozone Economic Sentiment Index for March out at 6 p.m. Singapore time. That could potentially have an impact on the German 30 and as well as the Euro dollar and the Euro crosses. And those who are interested in the dollar CAD at the Canada FX, Canada cross pair rates, at 8:30 p.m. Canada will release its inflation figure, all right, for the month of February. And thereafter, during the US session, there is no key tier 1 data. So the action will come in Wednesday, tomorrow, 19th of March, which I explained earlier. 11 a.m. will be Bank of Japan interest rate decision. Market is expecting no hike at 0.5%. But like I mentioned earlier at my start of today's daily dose, keep a lookout for the monetary policy statement. Potentially, they may sound more positive on higher wage growth that is being played out in the Japanese economy, and that could actually provide much more guidance for Bank of Japan to have a what I call continuation of their normalization interest rate hike policy, and guide the market that the next potential rate hike may come into the summer months of 2025, either in June or July. And thereafter, we will have the US Federal Reserve decision, which is on 2 a.m. Singapore time on Wednesday, early Thursday, March the 20th. And what's interesting over here is they also released the economic projection. All right, so this economic projection is the dot plot over here. So this dot plot in the previous projection, you could have it on the website. You could see on the website over here, the Federal Reserve website. So previously that was in 2024 in the December meeting. So if you look at the December dot plot over here, you could look at my screen. So what I could see over here is that the US Federal Reserve officials, the median projection, they actually has a higher Fed funds rate at 3.9% by the end of 2025. So you get 3.9% minus of 4.25% of or 4.5% now. That actually implied only 2 interest rate cut for 2025. And what's interesting right now, the market will now take a look at the core PCE inflation projection, which was also upgraded previously in December from by 2 basis points to 2.2%. So any increase in this core inflation 2.2% will that means to any increase in 2.2% in 2026, and as well as 2.5% that was projected earlier in end of 2025 may starts to have a kind of impression the US Federal Reserve deem that inflation pressure may revive in the US economy due to trade tariffs policy. And so market also looking at their projection in change in real GDP. All right, so they actually penciled in a slightly higher GDP in 2025. Previously in September, they project it to be 2%, and in the December meeting, by the end of 2025, they're looking at 1 basis point increase to 2.1%. So any slight adjustment downwards back to 2% again in real GDP growth in the US economy by the end of 2025, that represent the risk of stagflation. That means slower economic growth, whilst we start to see a sticky inflation on the upside. That's something to take a look out for on tomorrow. That means early tomorrow, Thursday, early Singapore time at 2 a.m. All right. So with that, that sum up today's daily dose of market insights. Tomorrow I'll be on leave on 19th of March, and I'll be back again on the 20th of March. So I should see you all on Thursday, 20th of March, and do have a great day ahead, and we shall speak again. Thank you.